In this example, we're going to be looking at closing entries, specifically the first step of closing entries, which is to close the revenue accounts. So it says, assume at the end of the accounting period there are credit balances of $3,400 in our patient servants revenue and $1,800 in laboratory fees revenue, and we need to prepare the required closing entry. And the accounting period ends on December 31st. So we have two revenue accounts, which is not uncommon for businesses. And since they are revenue accounts, they have credit balances. The purpose of closing them is to bring them to zero in order to start the next accounting period fresh. So if I have a credit balance of $3,400 and $1,800, in order to make those zero, I'll need to decrease them, which is done with a debit. Closing entries are also always performed on the last day of the accounting period, so you'll notice here that the date, December 31st, is already written in. So I have to debit two different accounts. I'm going to debit my patient services revenue in the amount of $1,800, and I'm going to debit my laboratory fees revenue. I guess I got those amounts backwards, $3,400 and $1,800. Be careful and read carefully. And we put these amounts into our new temporary account that we've learned about in this chapter called income summary for the sum of $5,200. So just a little bit on the income summary account. Remember, it is a temporary account, as is our revenue account. All the accounts we close are temporary accounts. And our income summary account is only used on the day that we close entries. We're going to open it and we're going to close it in step number 3. So you'll never see it on any financial statement, nor does it have any normal balance side. So that's what we do to close our revenue accounts. We bring them to zero, and then we credit income summary for the total amount of our revenue.